I did say that the perception of interest rates coming down was probably going to cause a little spike in the UK property market, and indeed we've just seen, well, both nationwide earlier this week with a month-on-month price rise, and Halifax coming in today with another month-on-month, in fact the third month-on-month price rise in a row. So I wanted to do a quick live. It's Friday afternoon before I shut down for the weekend. It has been a long week, I can tell you, first week back. To give you my reaction on the Halifax's house price index, let's crunch the numbers, see what's going on, and I want to answer the question, have we actually troughed in terms of nominal house prices, or is this a little bull trap that's happening? Is this the calm before the storm? Is this a perception-led mini rally before we go into 2024 and we see some further issues, systemic issues in the UK housing market? So let's have a look at that. Let's dive in without any further ado. So when we look at the Halifax HPI, we can see we've had a monthly change of 1.1% up, okay? I'm not so fussed about the quarterly, but it gives us an annual change of plus 1.7%. Now, don't forget, this is December. So what this gives us is for 2023, according to the Halifax House Price Index, house prices rose by 1.7% in 2023. Now, let's face it, team, right? This is completely against what all the narrative was at the beginning of 2023 and for most of the year, where we've had, very strong narratives of massive property crashes, doom mongering, and of course that's been tempered by the other side. But I would suggest in the YouTube sphere, the majority of the narrative has been extremely large falls. Now, I'm not saying that is not going to still happen, right? I've always said that because of the fundamentals that we're looking at, there's going to be a temperance of nominal house prices with a long and shallow decline. And as always, I don't want to read too much into month on month, but we are now 3 months worth of house price increases. But before we actually look at the graphs, okay, I just want to zoom in and look at what the actual narrative, there's the statement from Kim Kinnaird, the director of the mortgages. So I want to just highlight it so you can see it. Here we go. The growth we have seen is likely being driven by a shortage of properties on the market rather than the strength of buyer demand. And I think for me, that is probably the key part of, if we read in between the lines, okay, this is not everybody's flooding back into the market. Of course, there is going to be a perception boost. Let's face it, there is also, right, a slight increase in housing transactions or mortgage transactions. If we look at the mortgage approval data, and the last set of data we have here is showing a slightly increased. I think we're like 49,000. If I go into, let's go into the column actually, so we can see the figures better. No, that's still not giving me the figures very well. There we go. That's what I wanted. 47,888 in October to 50,067 in November. The problem is when I look at this data, I'm like, we're looking at September, October, November, this sort of data. I would suggest that the lag in the perception or the lag in the system from inflation coming down, let's not forget the first large or unexpected drop in inflation was the print we got in November, and then the second was the print we got in December. And this data is November 23. So this data is the mortgage approvals for the same month. And don't forget, the CPI print comes out nearly the end of the month. So that first large drop in inflation probably came out near the end of November. I can't remember the exact date. So it's unlikely that this uptick in mortgage approvals is due to the public perception of inflation coming down and interest rates coming down more quickly. That really happened in December, okay? So if we look at the lines and if we go max and we go line, I look at that graph and it's not like we've got a massive spike. Okay, so as far as I'm concerned, yes, month on month we've seen an uptick, right, in mortgage approvals. However, we are still well below the historical averages. So the market is still frozen. And when we look at the narrative, right, even the director of mortgages over at Halifax says the growth we've seen is likely being driven by a shortage of properties rather than a strength of buyer demand. So that's the figures we've seen here from Halifax and also from nationwide is almost certainly a lack of supply. And when we've looked previously at things like the Zoopla HPI, which gives that flow of new supply, we've seen for the last few months a flow of new supply. Even though the actual supply has got more because nobody's buying, the flow of supply has been negative, right? So we're still seeing that property market in paralysis. Now, that is not to say that over the next quarter, we are not going to see an uptick of interest and uptick of buyer activity with now the perception of mortgage rates coming down. We know that swap rates are down. We know that banks are competing for mortgages. And I've said that I would probably hypothesize over the next quarter a tick up in the HPIs as we see some of that pent-up demand probably being released as the perception that we've bottomed or topped, if you like, in terms of mortgage rates has occurred. However, what I want to ask the question of, right, is regardless of month on month, quarter on quarter, for me, this is a dangerous time. This is a dangerous time for unfounded optimism and perception coming into the housing market, because of course the reality of the housing market is it's going to be completely linked to what happens to the economy in 2024. So regardless of what's happening with swap rates and mortgage rates and all that sort of stuff, and I don't want to go over the gap and how many people are coming off their cheap fixed rate debt in 2024, still over 1 million people. For me, the real key of what's going to macro affect the housing market this year is what happens with the economy. Now, of course, will that be artificially popped up as we go into election cycle? So let's actually go into the actual figures. Okay, so I'll come back to questions at the end, by the way. As we look at the graphs, okay, you look at that graph. Can I zoom in on that? I probably can because I'm on PDF mode. There is a clear direction in trend here in terms of all of the lines, which is annual, month on month, and monthly percentage change. The big one that we can see that's really showing very obvious here is that annual change, right? So some might say we have bottomed in terms of nominal terms here. However, I would say we have broken the trend line. And if we come down and look at the actual nominal in a graph format, I've been talking about the trend line, the channel we've been charting down here. Okay, I don't know if you can see the cursor. We've got a channel charting down here. I would say that trend line has been broken. So from a purely trend line point of view, I would say this is a reversal in trend, okay, for the prices. Please do not forget, however, that we are looking at the HPI's house price indices for lenders. Lenders have an agenda. They have an agenda to get people eyes on, their bank so they can get money out the door. Okay, so that's the first thing. Second thing, this is based purely on mortgages, right? And it's also a hedonic regression model. This is not actual house prices. This is a model that gets put together and it has seasonal effectiveness to it. By the way, I started to research this before coming on here. I haven't had a lot of time. I had about 10 minutes to put the not the slides together, but to put the windows together here. And I found the actual methodology, the X11 procedure that that is used to do the seasonal adjustment model. And if you look at it, right, I just want to try and make this kind of obvious. The whole point of the seasonal adjustment model is to smooth things out when you've got a lot of changes in seasonal transactional volumes or sales or values or things like that. And clearly, we're going to see big differences in the property market in spring when everybody's out buying versus, sort of depths of winter or August when everybody's on holiday. So the whole point of this is smooth it out. What that does inevitably is it causes skews in the data and it causes anomalies in the data. And if there are big skews, and it even says here, right, if we look at this, there's a paragraph here that talks about the inherent problem with the X11 method is the revision of the seasonal factor. And if we go back into this time last year, but if we go back in December, November 22, don't forget there was a big change in things when the mini budget happened, and effectively it just sort of threw a hand grenade into the property market. And I still think when you look at year-on-year basis, okay, that's going to have an effect on all of this. So that's something to bear in mind. So hedonic regression models are not actual house prices, is a model with a lot of things going on. So therefore, these will be affected by things like pound per square foot, transaction volumes, and all the models have said that the transaction volumes are still so low, the data is not, the models are not actually accurate. So we have to take all of this with a pinch of salt. However, when we take it with a pinch of salt, right, these are the headlines. This is what's going on in the headlines right now. And therefore, if that's the headlines, this will change perception. And we cannot underestimate the power of perception to move markets, at least on a temporary basis. Okay, so if we go and have a look at the news, if I just show you my news feed quickly. Okay, I need to just bring that down so you can see the top of it. This is now the sentiment that is going through the newsfeed. And don't forget, I talked about the psyops last week. I talked about the misinformation. I talked about the narratives and implanting storylines. We go into election cycle. Let's just look at some of the headlines here. Okay, we've got buyers return to housing market as mortgage rates decline. We've got exact dates interest rates could be cut in new mortgage boost for millions. We've got 8 reasons to be cheerful about the UK economy. Okay, when you look at this, we're looking at positive storylines in the mass media, and that will of course influence perception. So I would not be surprised, as I've said before, to see people going back into the market, okay, on a short-term basis. But it's dangerous. I feel we're at a very dangerous time for people, because if the economy tips, if we go into recession, okay, people could be even more exposed if they're taking on debt on higher interest rates, right? Right now, or locking in, or whatever it is, right? The recession could still take it down. I'm not making any predictions about that, by the way. I do not make predictions. I just look at the data. The only other thing I wanted to highlight, right? If we go back over here, on the where does it say it? On the actual HPI, there we go. This is the forecasts from the Halifax themselves. So regardless of what's happened, regardless of them saying we've gone up in 2023, statement, our latest forecast suggests house prices could fall between 2% and 4% during the coming year. Although, as with recent years, forecast uncertainty remains high given the current economic climate. What they're saying is what I've been saying for the last couple of months, that we are all over the place with the data. There is no definite trend, there's no definite logic at the moment, because all the data is so small in terms of data set, it's making it very difficult to come up with accurate models. And therefore we have to take everything we see with a pinch of salt. And I would rather go anecdotal right now and see what's actually happening on the front line in terms of the amount of properties having price reductions and all that sort of stuff than these sort of HPIs. There was one more thing I wanted to drag out of this. I'm trying to remember what it was. Oh no, I've lost it for some reason. It was the real, if I go nationwide, is that it? There we go. This is the thing that I always come back to, team. This is the thing as an investor that I actually care about. This is the inflation adjusted house price index by nationwide. And even though every week, every month, we talk about inflation and we talk about the issue and what inflation means and if it's real or if it's not real or if it's being underblown or overblown. And so many times I come on and said, right, if we're looking at house prices, I know that most people do not care about inflation adjusted house prices. If you're a homeowner, right, then if yours is going up or down for inflation, then everybody else's around you is going up or down in inflation. So relatively, you're pretty much going to be staying the same, right? So it's not a big an issue, although it creates the perception of adding wealth. Again, perception is such an important thing in the market. As an investor and a developer, this is what I care about. Okay, I hope very soon we're going to have Q4 2023 results from the nationwide. It might be out already. I haven't been able to find it. I did just do a very cursory look. Okay, but when you look at that graph, okay, when you look at that chart, there is no doubt that we have seen a significant correction in house prices on an actual inherent value point of view. Because we still have, even at the inflation where it is now, it's still 2.5 times above target, right? With nominal house prices effectively sitting pretty flat. Yes, all right, year on year, we've said 1 point whatever. That's flat, right? We're pretty much flat. With inflation high, that means, again, over 2023, the actual inherent value of your properties have eroded with inflation. Okay, so nominal is being propped up by the strong wage growth. This is what I mean. If we go into recession and if people start to go unemployment, I've seen the forecasts are not going crazy, but unemployment to go up. If we've gone to peak of wage growth, right, that's going to start to affect those nominal wage growth, and therefore that will start to affect the nominal house prices as well. So I just wanted to do that. I don't want to go long today. Very quick one before we knock off for a Friday. I am aware it is Friday, and I think I've got a gin and tonic waiting for me somewhere. I just want to go to some of the comments. Rab saying some YouTubers predict a 35% drop in 2024. It might happen, Rab. I'm not going to say yes or no. I don't make predictions. I think anybody who makes predictions fundamentally, we'll probably get it wrong unless you make lots of different ones and then you pick the one that actually happened and put that on your highlight reels at some point. Anyway, I'm not just being nasty to other YouTubers. I'm just saying I think nobody can call it. Nobody can pick it. At the moment, the market is entirely illogical. Or is it? Is it actually entirely illogical? Or is it actually panning out pretty much what I've been saying for the last 6, 7, 8 months since I started this channel, that the fundamental factors, right, of high inflation, high nominal wage growth will lead to a complete propping up of nominal house prices. In the meantime, real house prices are crashing in value because that's the way it works. To me, it's kind of pretty much where we are. I am slightly surprised we've seen the Halifax have 3 house price rises in a row. And again, just to go back to that graph, just to illustrate the point, I am slightly surprised that we've popped out the channel so early. And if we look at this channel down here, but don't forget, this is not stocks and shares. We're not charting, Apple or crypto or Bitcoin. This is a property market which has got so much lag in the system, so much inertia in it. We can't use traditional charting. I kind of use that as a sort of 50,000 foot view from down. So we have broken that trend line, but that does not mean that it won't flatten off and come down. Even Halifax predicting 2 to 4% drop in 2024. And looking at my suspicion is wage growth will now stall. More people are coming off cheap fixed rate. That gap is still widening, right? So there's more people coming off cheap fixed rate debt. So the debt service ratio, aggregate debt service ratio for the UK is going up still, not as much as it was last year. And the economy is not looking good. So, my suspicion is we will still see small nominal price falls over the next 12 months. That will accelerate if we go into full-blown recession, okay? And we just don't know if we're going to get there or not. So that's my thoughts on it. Stafford says, just to make the point there. So my overall point is I don't think this is really defying logic. The only thing that is defying logic is maybe a higher than expected bounce in December. But let's just zoom out, team, right? It is a small data set. It is a skewed data set. If we look back at the data, in fact, I'm going to bring this up right now, right? Bear with me, team. I said I was going to not take long, but I just want to try and make the point here. So I'm going to get Zoopla's stuff. Okay, so that's December. If I get November, I wonder if they just have them all published like that. Zoopla, there we go. Yes, we have that. And if I can find October, should have had this prepared beforehand, team, but bear with. Is that it? There it is. Right, so there's December, November and October. Right, and let's just plug on over here. So let's go back, December. So this is Zoopla. By the way, I really respect the model that Zoopla have. And one of the things I've been talking about a lot is not the stock for sale, right? Because everybody's going, stock for sale is going up. It's right compared, we've got loads more stock for sale compared to 2022 where there's no stock for sale, right? The reason there is no stocks for sale is because people aren't buying. The thing that I've been watching is that flow of new supply. Because the flow of new supply, if we're not getting new supply on, right, then it shows there's a massive supply-demand imbalance. So if you look at December, okay, we've got 1% compared to December 2022, which is straight after mini budget, and it's flat compared to 2019. If we go to November, we've got a negative flow of new supply year on year compared to 2022. If we look at October, flow of new supply is minus 6%. So really what we're seeing here is we're seeing a very low amount of new supply of stock coming onto the market. So there's been a huge supply demand issue. So if you filter that through, right, that is without a doubt not propping up the market, but it just means the whole market is frozen. So because the transaction volume is so low, we have to take these skews with a pinch of salt, especially as they are seasonally adjusted skews, right? And the seasonal adjustment black magic would quite likely put this 1.1% up for December. There we go. Yeah, Trade It saying, what have I missed? 1.1% seems huge. Yeah, I think we've covered that. Trade It, perception doesn't improve affordability. You're correct. Trade It, perception doesn't improve affordability. However, have there been, have there? This is not just about affordability. There are probably still people with a lot of liquidity, I would suggest, in there, who can borrow less but still have liquidity, whether that's post COVID liquidity, whether that's bank of mum and dad liquidity, whether that's savings from nominal wages going up. So I had very anecdotal, and I'm sure you might even be watching this. I had a lovely call today with somebody who has seen their wages go up significantly over the last 2 years, and accelerating away over the last 2 years. I believe financial services or some sort of services based, and that actually, ironically, for those people who are not right now dependent on mortgages or have mortgages or on high interest, and don't forget, there's still a huge amount of people on cheap fixed rate debt. So if you're on cheap fixed rate debt and your wages are going up considerably, that's giving you a buffer to save. So you're going to have more liquidity in there. So you don't actually have to borrow so much in the first place to go and buy something, right? So with the perception that interest rates are coming down, I suspect there's been a lot of people sitting on the sidelines, and this is one of the issues, right? Both sellers and buyers. Sellers aren't selling, buyers aren't buying. People sitting on the sidelines waiting for interest rates to come down, because inevitably they will at some point. With the perception of interest rates coming down, and swap rates are coming down because of the perception, so the markets are betting that we're going to drop quite a lot this year. With the swap rates coming down, mortgage rates coming down, your affordability actually increases. So people getting new mortgages now can afford to borrow more because the interest rates on mortgages have come down. So actually we can afford to borrow more, and the perception means they could be out there shopping. So that's my thoughts. Robin, how are you doing? My perception is that, let me put this on, Robin. My perception is that people are prioritising housing costs over other purchases. Used car prices have crashed. I think mortgage stress tests have worked so far, but economy on brink of recession. I agree completely, Robin, in terms of what you've said over the mortgage stress tests have worked. I think mortgage stress tests have been very high. I believe over the last couple of years, like 8-9%, they've been stress testing. So that has worked. So far, it will come at a time. It will end if we go into recession, right? People, if they lose their jobs, doesn't matter what their income is. If they lose it, it's going to go down. The reason used car prices have crashed is, from my point of view, because there was so much pent up lack of supply a year and a half, 2 years ago with the semiconductor crisis. And there was such a lag period with new cars coming on, therefore lack of supply, huge amount of demand. That's now been sorted, so that sort of demand has dissipated somewhat. So I think that's had a big factor on it. What else we got? Rishi calls Stafford reckons. Oh, should we take some bets? Let's take some bets. By the way, so Stafford saying here, Rishi calls snap March election on the back of perceived bettering of cost of living. What do you reckon, team? Put in the comments where we reckon the election is going to be. Do we reckon March? So there was a good article that I'll just bring up here. So I reckon back end of the summer, because I think that's when they probably got their best chance. Let me just bring this up. We've got a good narrative here of kind of some of the things we've been talking about why they won't do it earlier. Yeah, what do you think, team? Whack it in. What do you think? I think back into the summer, personally. Maybe August. August would be a good time. Everybody away on holiday. And they're probably going to, it's probably everybody's in a good mood in August, aren't they? Away on holiday, or they can't be bothered to vote and all that sort of good stuff. And you'll probably get some good data there with inflation, if it's manipulated or not, down as much. And of course, people don't care too much about energy. And the energy price cap forecast is that will be lowest in that third quarter, which of course August is in Q3. So I think Q3. That's my bet. Q3. Right. Rab says, is deflation a possibility? 100% Rab. I did a video on this, I think, just after Christmas or just before Christmas. I actually think deflation is a possibility. And I think that's probably one of the more worrying aspects, or when you look at upside downside risk, I think that's the probably biggest risk at the moment is deflation. And Robin says, yep, if recession is key, people start losing jobs, all bets are off. I agree wholeheartedly. wholeheartedly. There we go. Right. That was quick. I just wanted to go quick and dirty. It is Friday. Everybody should be enjoying their Friday right now. So I'm going to call it a day. Hope you've had a great week. Hope you have a fantastic weekend. We'll see what a logical, incredible data gets released from the various sources next week. It's a constant roller coaster and smorgasbord of things to talk about on YouTube. As always, please team, I feel we're growing a really fantastic community here. I'm speaking to lots of people every day who contact me now and arrange strategy calls and looking for help to grow their portfolio and get into property this year. I feel we're doing really well in terms of building that community and helping others understand how to do this properly and reduce the downside risk. And that's down to everybody supporting this channel. So please, my only thing that I ever ask you on this channel, because everything I do here clearly is for free, and there's a lot of time and effort and research that goes into doing these. Please support me by subscribing to the channel if you are not subscribed already. If you're here, if you've seen 2, 3, 4 of these live streams, either on record or on live, you're not subscribed, please do subscribe, because it would mean an awful lot to me. It helps me get more reach, and then I can have more resources I can put into doing this better, which is what I want to do in 2024. So please do that right now. Otherwise, I will sign off and I'll see you next week.